Hello everyone, our topic is Mr. D.I.Y Financial Analysis. Our group members are 马一瑞、马家威、马佳慧、乌可 and 刘新月. First, the D.I.Y and retail industry sells low-priced household and daily use products. These products are things people need every day, so pastry demand is quite stable. This industry has three main points. It has many types of products. Products are sold quickly, but profit per product is not high. Now, let's look at Mr. D.I.Y group per head. Mr. D.I.Y is the largest DIY store in Malaysia. It offers good value for money, fixed prices. The company sells a large number of products to make profit from small margins. As of 2024, Mr. D.I.Y has over 1,300 stores in Malaysia.
Hello everyone. For this slide, I will explain the liquidity ratio of D.I.Y. First, we look at the coverage ratio from 2022 to 2024. It increased from 1.91 to 2.78. The main shows that the company's short-term liquidity is supported and improving. So next, the quick ratio. Although the quick ratio is lower, it's also showing an upward trend over the 3 years. So, like this is normal of a retail company like D.I.Y because a large part of it is access its inventory which can be sold quickly. So therefore, D.I.Y is about to make its short-term obligations. Okay. For this slide, I will focus on access management and comparison. First, the inventory turnover increased slightly from 2.21 to 2.32. The mean which shows that D.I.Y is making its inventory more effective. The total access turnover remains supported around 1.2. indicating that the company is using its excess inventory to generate sales. When compared with D.I.Y shows higher efficiency. This reflects D.I.Y first mover retail business model.
On this slide, we can see D.I.Y data and risk ratio over the last 3 years. The data ratio has dropped from 56.9% to 49%, which means the company is relying less on the data. The debt-to-equity ratio also fell below 1, showing that equity is now the main source of funding. At the same time, the times interest ratio saved above 10, so the company can easily pay interest overall. This shows that the company's expansion is supported by its own funds rather than executive borrowing, keeping financial risk low. Here, we summarize the company's financial risk. Mr. D.I.Y data is moderate and well managed, and the decline data and D/E ratio shows stronger reliance on equity. The high times interest earned means the company can comfortably meet interest payments. Overall, financial risk is low and data is used to support growth, not cover losses. The recommendation is to combine balanced growth with the data while keeping financial stability.
From 2022 to 2024, Mr. D.I.Y improved gross margin sharply in 2023 and sustainedly in 2024. This suggests a better product mix and improved cost control. Net margin improved in 2023 but eased slightly in 2024, hitting at a higher operating cost or financial-related pressure. Overall profitability remains strong, but management must protect net margin at its scale. In other words, the company is still earning well at the gross level, but some costs below the gross profits may be rising. If operating expenses grow faster than revenue, net margin can soften even when gross margins stay high. Therefore, Mr. D.I.Y should continue to manage cost efficiency carefully so that expansion does not reduce overall profitability. Now let's talk about ROA and ROE trends. ROA stayed around 50 to 60%, which means the company used its assets to generate profit very efficiently. ROE is still high, but it's a fall in 2024 because equity increased and the company relied less on average, so the equity multiplier becomes smaller. In short, ROE looks more normal, but the company is likely less risky and more stable. The last is DuPont Analysls show that Mr. D.I.Y higher ROE mainly become from operating strengths, a higher net profit margin, and a faster asset turnover. This means the company keeps more profit from each ringgit of sale and generates sales efficiently from its asset base. In comparison, AON uses higher leverage, but its business is more asset heavy and its margin are thinner, so its ROE remains lower. For Mr. D.I.Y, the priority is to protect net margin and retain turnover by controlling operating costs, avoiding excessive discounting, and keep inventory moving efficiently.
This slide shows how investors see Mr. D.I.Y compared to year in 2024. Even though it has a slightly higher EPS, Mr. D.I.Y is priced much higher in the market. This higher PE ratio means investors expect Mr. D.I.Y to grow faster in the future. The much higher market-to-book ratio is also show strong confidence in Mr. D.I.Y's business model and profits. From an investor point of view, Mr. D.I.Y has clear strengths such as stable earnings and strong market confidence. However, high valuation also means investors have higher expectations. So, the company should keep profits strong at each store, control costs at the expense, and clearly explain its growth plans to investors to maintain confidence.